been feeling blue. My money is too. Shawty act rude till she seen it too. I've been feeling blue.
What's up, everybody, and welcome to another episode of What's the Dealio? I am your host, Siano, here with my partner, Mike Steinberg, and an amazing guest today. We have Ashley Markowski from Lease. Ashley, welcome to the show.
Thank you so much. I'm so happy to be here.
Amazing. So, Mike,
I just met Ashley.
Yeah, let's dive in here.
Yeah, there's so much business to do because she finances businesses and real estate, and she could tell you much more about it. But already we're doing business deals, just meeting for 10 minutes.
Yeah.
So Ashley, thanks so much for joining.
It's almost like speed dating. We kind of got this quick 60-second intro.
Yeah. If you can just let everyone know what you do, who you are, that would be amazing.
Yeah, absolutely. So I work for a company called Lease, and I have been in the industry for almost a decade. And I work with fitness and wellness businesses. I really like to focus on franchises. That's where my passion is. I think there's a lot of scale opportunities. And so I help franchisees, and we also help non-franchises as well, but predominantly in the fitness and the wellness space.
Which is why we're very close friends for many years. So a lot of overlap between what Ashley and I do. And as we know, and we were talking about this before we hit record, if businesses cannot access capital, they are not in business, which is why Ashley's a very important person in my world. And her companies do way more than health and wellness.
Yes.
Similarly to, Sabre, even though I personally like to specialize in healthy lifestyle space. But we're talking, and Mike, there's a lot of opportunity, obviously, with the businesses that you like to focus on.
Absolutely.
Yeah.
She was going over, even with these interest rates where they're at, if you're investing in a business, it's either you're going to pay more when the interest rate is lower, or you're going to realize that the profit is the interest rate's minimal compared to the profit.
Exactly. Yeah. Opening up a business and having funding available and capital available to you to grow and to open your business is so much more significant than the interest rate environment that we're in right now. And I kind of had said this before, if you look at an amortization schedule, oh God, I'm put everybody to sleep with that one. Not going to get into the finance, but I get into the weeds with that. But if you look at a monthly payment at an 8% interest rate compared to a 10% interest rate, the difference in the monthly payment is insignificant compared to the value of opening up a business and the ROIs on that.
Yeah, it's super interesting because my companies are heavily involved in the franchise space. We also do corporate, as you know, but we have a lot of, both on the scaling of businesses as well as the sale of businesses, where Mike and I are partners, heavy in the franchise space. And I think what's so amazing about what you do personally, like within your company and just kind of your passion, is helping people get open businesses, right? I know you're super passionate about helping folks that maybe can't get their funding elsewhere and SBA. Yes. Talk a little bit about that.
Yeah. So I look at what I do. Obviously, it's a product. It's conventional financing, but I look at it as like I want to help the industry. So when I get presented sometimes with candidates who are better, suited for SBA financing, I will encourage them to go that route. I have a lot of connections in the industry, and I'm just big on helping the person. And that doesn't mean that I'm necessarily the solution, but I'm going to help them find the solution, and I'm going to put them, in a network and surround them with the spheres of influences that are going to be able to help them get there. And so I think that that's really what becomes valuable, because it's not commodity based. And I think in lending, especially with the bigger banks, the the Chases, the TD banks, the larger institutions, it gets very commodity driven.
Sure.
And the value in what I offer is, obviously my network of connections in the industry, but really understanding the industry because I'm also equally passionate about it.
And you mentioned to me before, you don't have a prepayment penalty for your products. Right?
So with the prepayment penalties, so funny, we're really getting into the weeds here.
Well,
Oh
I
my
mean,
gosh.
this is the good stuff.
This is
I
great.
love
We're going to
this.
make a deal by the end of this
I hope everybody
podcast.
is still awake on this podcast.
I mean, think about it though. If you're really bored by like prepayment penalties and the amortization schedule of something,
Right.
you're probably not really good at business because these are really important.
Yeah, I mean, we can
Yes.
go over it after, but
No,
these
this
are
is so,
important
it's,
things. What do you mean?
so
Like-
my top 3 questions that I get asked, what's the interest rate? Are there prepayment penalties? How quick can I get funding? Now in this shift of high interest rates, the number one question has become how easy and how accessible is funding. So anyway, to circle back to the prepayment question, because that's a great one. There are prepayment penalties involved with our loans, but I don't like to call them penalties. I like to call it yield maintenance, because to really explain what it is that you have the ability to pay off the loan early. Usually after 12 months is when we allow that. And what'll happen is there's a metric that we have. It's a 3-2-1 rule, and it's 3% of a penalty on the principal balance only, and it reduces to 2% and 1% the further out the loan that you want to prepay. So if it's let's say a 5-year loan, in year 2 there'll be a 3% penalty on the principal balance only, 2% in year 3, 1% in year 4, and so on and so forth. And you're still going to save a tremendous amount of money by prepaying the loan. Especially if you have a 10% interest rate. If you do the math and you service that loan over the entirety of the loan, you'll see the interest that you would pay. And what our product allows is the early payoff, but there has to be some initial direct costs, which is called IDC. And every lending institution has it. It's what covers your payroll. It's what keeps your lights on. So it's not that we're charging this penalty on the unamortized interest and principal that is for the length of the loan. So I'm big on transparency with that and educating. And most of the time when you explain it that way, people understand.
I like that. You switch the verbiage.
Yeah, it's yield maintenance, because if I'm borrowing a cost of funds based on today's rates and you want to pay me off early in 2 years and I'm expecting a return over 5, 7, 10 years, I'm breaking ultimately that treasury, index that I have at the time that the loan was booked, and I'm subject to whatever it is at that time. So there has to be, some return and cushion and insurance to be able to cover just my immediate costs of running the business.
Sure. And being in the business, can you tell the audience why they wouldn't want a prepayment penalty? Just so they want to refinance. What's the main reason why?
Yeah. So in the environment that we're in right now, what I've been able to strategically offer and work out with our bank is we will refinance when rates come down. Usually I would say to make it worthwhile for the borrower and for us, 150 basis points or more. If the rate comes down that amount, we'll refinance the loan without any prepayment penalties, without any closing costs. So there are ways to avoid prepayment penalties. If there's a sale that potentially is going to take place, so some of my clients already know I'm going to, tee up this business, I'm going to get it profitable, and then I'm going to sell to private equity or to another, owner. I'll say to them, introduce me early on to these private equity firms, to these potential buyers, because then they can assume the debt and a transfer and assumption can take place. Therefore, you won't be subject to prepayment penalties. So there are absolutely ways to avoid the yield maintenance and the prepayment penalties, but it's really important that, in the beginning, in the early on conversations, I fully understand, the business plan that's going to take place.
Yeah. So you and I have a lot of shared clients, and Orange Theory Fitness is one of them, right? And you know, you're still heading out to the annual conferences, and that's actually Dave Long, my homie, the CEO of Orange Theory, actually sent an email last night, and he was talking about how he's just super busy leading up to the conference, which is a few weeks out. My question to you is, how are you able to help a franchisee that has, you know, little experience, if they're new to a brand like an Orange Theory, just as an example, right? But they don't own any franchises, they're coming out of corporate or whatever it is, and they want to buy a franchise. How are you able to help them? And you know, maybe what's the difference between SBA and what Macro Lease offers?
Yeah, that is the true, you know, startup that I do. I get those opportunities a lot, and you know, it really depends on the situation of the borrower. Sure. So I would say that I consider you know, conventional financing typically something that you graduate from SBA, and then, you know, I look at conventional financing as almost like going for your master's degree, you know, if you choose to take that step, because conventional financing usually requires either businesses that have established cash flow already, or in this case, if it's a true startup borrower that doesn't have that and is a corporate refugee and is now entering franchising, usually will expect some more skin in the game. So, you know, the ideal individual would be somebody that has maybe the capital to self-fund the entire project, but they want to be strategic and they want to scale. So in that case, I would say we'll come in and we'll do, you know, 50% or 60% of the funding, and we're going to expect, you know, a higher down payment, a higher equity infusion on your end, you know, so maybe 40% upwards. You know, the individuals that are coming in that, you know, are looking to put 10 to 20% down, and, you know, they're maybe a little unsure of the potential of cash flow for the business, might be better suited for, well, I would say definitely better suited for SBA.
Sure.
That's going to be a 10-year amortization. That's going to be less money down. So that's usually where I direct those types of individuals. And then I say to them, you know, in 2 years, when your business is established and when you have profitability, come to me, because I'll refinance. A lot of SBA loans
finance businesses.
Yes,
Very
yes.
cool.
We do acquisitions, and you know, the SBA tends to have variable interest rates. So that is also another incentive. The SBA takes personal real estate as collateral. You know, SBA is a wonderful product because it helps those individuals just get that start that they need. Sure. But conventional is, you know, I have a lot more autonomy and ability to like customize the types of loans that we provide. I get really involved and into the weeds of the structuring of deals. So if there's like, I have a really great client of mine who wasn't able to get SBA funding. And I rolled up my sleeves and we came up with some solutions to be able to get her what she needed to get the funding conventionally, because SBA wasn't an option. And, you know, they have ROBS programs where you can roll over your retirement funds. So, you know, essentially, if you're leaving your corporate America job and let's say you worked for Apple, you own tons of retirement in Apple, you can actually sell the Apple stock, open up an S Corp or a C Corp and convert those shares into your own business and access retirement funds without getting penalized if you're, you know, under 59 and a half or whatever the restrictions are. So there's so many different, you know, channels and networks.
So happy I met you.
Oh, thank you.
Oh my!
I'm the money girl.
You know. Yeah, I mean,
Wow.
it's so in that case that you were able to do that where she did not qualify for SBA. Was her,
Oh boy.
are we still going? Was it her first franchise business that you were able to get her funding for, or was it
In this case, she had one location that had been open already, but she had I guess a different type of, it wasn't SBA, it was some sort of government loan.
Okay.
But they had liens on like her investment property, her regular, like, so they really had her tied up.
Sure.
And so in that case, I was able to refinance it conventionally. But in cases where, like I said, there's no other businesses that are, involved, or it's a true startup, that's really where, maybe I might say to the individual, put up a CD. Or if you've got, marketable securities, stocks, bonds that are sitting in an investment account, we can temporarily lien those assets for the first 2 years of the loan. And then what happens is I provide a recipe to be able to release that collateral. So like debt service coverage ratio formulas, prompt payments. And I get really into the weeds with my clients. Like, this is the EBITDA that you have to provide by 2 years compared to the debt service. And this is, what I need the business to achieve in order to release that collateral. So that's another way of structuring.
So if I had a Morgan Stanley account or any stock account, you can leverage against that?
Yes.
And you do that personally? You can help me with that?
Yeah, like what I would do is, it would be a control agreement. So there'd be a pledged account. So, if somebody has $1 million in a Morgan Stanley account, but they only need to collateralize 200,000, you open up with Morgan Stanley a pledged account, put the assets in it. And then what happens is a control agreement gets executed where you'll have the ability to trade, but the account has to maintain the required collateral value. And so then what'll happen is you'll be able to continue earning interest, and you'll be able to keep your assets with Morgan Stanley. We actually have a wealth management team as well. So like we're a bank, so we offer, and that's a whole other avenue that I'm spearheading this whole division of. Like, for the longest time, we were just commercial lending to businesses. With everything that's going on in the world with banks and I'm at a point now where I'm like, wait a second, everything's digital now. So our bank is Brookline Bank, which is in Boston, New England area. Historically, 10, 20 years ago, they only would service their region, because that's when humans actually went into, like, when was the last time you went into, right?
What's that mean? Who's a bank teller?
Like, I don't remember the last time I physically walked into a bank. Like, I do it from my phone.
Right.
So with all of the technology now, I want to spearhead, which I'm doing. I'm getting a lot of my clients to open up their business checking accounts with Brookline, because at the end of the day, we, just like all the banks, need depositors. We need people to come and to support us. And I feel like, support the mouth that feeds you.
Sure.
Chase Morgan and JP Morgan and Bank of America and those guys, they're not taking risk and funding these startups and helping the fitness and the wellness industry. They don't even, a lot of them don't really even understand what Orange Theory is. We're the ones, or care
to understand it.
We're the ones taking on the risk. So now what I am explaining to my borrowers, and I have to say, most of them have been so receptive of it. Come and be a full service borrower of ours. And that's going to be a really beneficial thing for a lot of these entrepreneurs.
So when you have somebody reach out to you, how much of a factor is the actual type of franchise or the specific brand that they're looking to get lending for, whether it's an Orange Theory versus an F45 versus, any other franchise concept out there? How much is the actual, call it strength and viability of the brand?
Yeah.
How much does that play a factor?
That's a great question. I always say the weaker the franchisor, the stronger the franchisee has to be.
Yeah.
The stronger the franchisor, then, there's a little more flexibility with the franchisee. But usually fitness and wellness is for, at least for the Macrolease side, because we have Eastern Funding and Specialty Vehicle that do other industries. That's usually the first thing I look for. But then now we do Tropical Smoothie Cafe, and we do, Kid Strong, and we work with a lot of, we're now in the med spa space. So what I would say is I like to have a conversation with the franchisor and really understand, where is this brand going? And, are you offering different options to your franchisees with funding? And so that's kind of how I start to qualify the strength. I would say, it's always ideal to have a franchise that has at least 50 locations. But if it's under 50 locations, then there's also that like organic, you're in such the ground level that I find those types of franchisors, if they really are invested in their network and their franchisees, they're going to go above and beyond to help us feel comfortable. So maybe, there'll be strategic partnerships that get aligned that a larger, franchise that doesn't need us is probably not going to do.
Sure. So you like working with more of you like working with startups?
I would say like emerging is because if it's too new, then I can't really help them. So if it's a franchise that only has 5 or 6 locations, it's going to be tougher for me, it's going to be tougher for them. But I would say like
unless those locations are profitable and
right, exactly. Like, so there's a franchise that I'm working with right now called Cali Coffee. And the franchisors are incredible. It's I think a husband and a wife. I don't know if they're married, but they're definitely they opened this drive-through coffee franchise in predominantly Florida is where they are. I think they're only in Florida actually, and they've built such a brand with just the aesthetic of like they have all these different stickers and these different types of drinks, and they're really gravitating toward like the college demographic, and they're huge on social media. And so they only have, I think, 5 or 6 locations open, but they've self-funded them. Wow. They know their market. Yeah. They're only focused right now on regional expansion. And so where we've been able to partner with them, and they're really being selective on franchisees. At first, they weren't even, I don't think, going to franchise, but they are a little bit now. And so in that situation, being able to see the self-funded, profitable locations, knowing that they know their market, we've been able to help them.
Yeah, I mean that's the most fun part about what we do. I think is seeing those concepts early, really becoming friendly with the founders of these concepts, and being along for the ride as they grow to 100, 500, 1,000, and beyond. Yeah, those are the most exciting journeys. Which Orange Theory, was one of those examples.
I grew up with that franchise. I mean, when I met Orange Theory, they had like 40 locations, and I think I was at Macrolease for maybe not even a year. Yeah. And I was straight out of college, and I knew that I had just enough industry knowledge to be able to like get in front of somebody who hopefully knows somebody who knew somebody. So I ended up finding Orange Theory at a franchise expo at the Javits Center. And you exchange business cards, and that's all great, but this is before social media. This is before
what
Instagram.
Year was this?
This was 2014.
Yeah.
And so I was a green banana. I really I knew just enough, like I said, to get my foot barely through the door. And I remember they were like, okay, yeah, we'll call you. Thank you. They were very, very nice, but it's a trade show. It's busy. It's all about the follow-up. And I remember looking at a Franchise Times magazine, and they had done an article on one of the area developers for Orange Theory. And it gave Eric Scholarud.
Yeah, of course.
And Colorado, yes. Yeah. Oh my God. Okay. Right. I forgot. We know. Right. So I remember, and then they were like, and he has this other brokerage business for lending and capital. Yeah. So I thought, okay, if I can't get in that way, I'm going to try to get in another way. And I called him. I Googled his number, and I remember being so nervous on the phone, and my heart was beating out of my chest because I wanted to make a phone call.
Sure.
Everybody gets email spammed. LinkedIn at the time was starting to really emerge, but I was like, I have to call and make that, that phone call.
That's the difference.
And yes. And I remember making his secretary answered, and she's like, who are you? And I was like, oh, I have a meeting scheduled with Eric to talk about Orange Theory finance. I said whatever I had to say to get him on the phone. He kindly ended up introducing me to, I think it might've been Dave Long.
Sure.
and a couple of the corporate people at that time. And so I sent them an email, and Dave is so like, just how do I put it? He's not, what's the word I'm looking for? Into like he's just authentic. Like he's just a real person is what I'm saying.
Yeah.
So his response was like, absolutely, let's set up a call. And I was expecting him to respond and be like, who is this girl? We're Orange Theory. We don't even, know who you are. And so it ended up being that I flew down to Florida with my mom, who has a condo in Del Rey. And I kind of just like knocked on the corporate door. This is when they were in Fort Lauderdale.
I love this story.
Yeah.
And I was so nervous again, because now I'm like, oh my God. And I haven't, mind you, I haven't even sold my company on Orange Theory yet.
Right.
So I'm doing all this selling. We can do this, we can do this, we can do this. And I haven't even told.
You're selling yourself.
I'm selling myself. And I hadn't even told the underwriters, the actual decision makers. And mind you, I'm at this point, I'm 24 years old. I have no industry experience. So when I finally got that lunch meeting with Orange Theory, and they were like, okay, we'll give you guys a shot, that's where I had to take it home.
Right.
And I had to convince now my underwriters, we need to do business with this concept. And we at the time were so heavily invested in Planet Fitness and big box gyms and, the $10 a month, that high volume, low price point.
HVLP.
Exactly. And so they at first were like, no one's going to pay $150 a month to go to Orange Theory when they can spend $10 and go to Planet Fitness. And I said, you're comparing, literally, pun intended, apples and oranges. You are looking at Planet Fitness and Orange Theory. They're not competitors.
Not at all.
And
They complement each other.
they complement each other. And so this was, Orange Theory was the disruptor of the boutique space.
Yeah.
And when I finally got my first break at doing a deal, I remember opening up the FTD, and calling every single area developer, because back then they had numbers and they had, and I just did it again. This is Ashley with Mac Release. We're a lending partner of of Orange Theory. And I made those phone calls. And then the beautiful part about it is I've grown up with Orange Theory. I now have a lot more industry experience, but a lot of those borrowers, those same franchisees, have moved on to other concepts and have now introduced, me to other concepts. And so it's been this really organic. So I have always in my heart a special place for Orange Theory.
I have to jump in here.
Yes,
so
please.
Sorry, Mike, to cut you off, but this is a passion. It's amazing because before you jumped into the Orange Theory ecosystem, when you did at 40 Studios or whatever it was, which is super early, obviously.
Yeah.
I started with Dave and Jerome when they were multi-unit franchisees for Massage Envy, probably call it like 4 years probably prior to them starting Orange Theory. It had to be around 2006, 2007.
Makes sense. Yeah.
And they took everything that they learned from Massage Envy and their network of successful franchisees from Massage Envy, and then they discovered European Wax Center. That's really what happened next. That was the next chapter for them. And they had a franchise development group. I mean, that's basically what Dave and Jerome were doing. And when they discovered European Wax Center, they're like, Jay, you got to fly down, check this out. What do you think? Da-da-da. Which is when I introduced, actually, I was on a site tour in Florida, and I introduced the Long Island partners that you and I both know really well. Yes. On that site tour, I introduced them to Dave and Jerome at a European Wax Center, which they were only two at the time. And they told me their plans to partner with the Cobra Brothers and to roll out European Wax Center. And then fast forward, probably only about, I'd say, a year and a half later, I was in a car with Jerome and his wife, April, and we were touring New York City for Massage Envy, because at the time they were still Massage Envy and European Wax Center. And April was telling us about Ellen's Ultimate Workout. And that was like, what the spark that started the idea for Jerome and Dave essentially to partner with Ellen and create a concept. And, to be like through that part of the journey
Yeah.
was obviously super special. I feel the same way you do.
Yeah.
And I'm saying all of that to say that it still goes on that way, right? Like all of the
course.
folks, including Eric Scholarud, who's a
Yeah.
longtime friend and was involved in those businesses pre-Orange Theory, and he
Exactly.
obviously benefited in a major way from being part of that community, as did so many of these other people that continue to go to different brands and stick together. It's really like a
Yeah.
community and an ecosystem that if you're a part of, you're blessed because you're seeing the best concepts early.
Exactly.
And it's, there's just strength in numbers. But I want to also say, like, to unpack, you said a lot, I want to unpack it. So there are not many Ashley Markowskis that work for any company. And, being an entrepreneur and starting my own business, it's like my biggest goal in life is to find people like you to hopefully come in and add value to what it is that I'm building. It's rare to have somebody that comes in and adds value and creates a new niche and, tells the owner of a company, no, you don't understand. Like, this is what's going to be like the future of what we're doing, and gets it and like explains, listen, Planet Fitness, yeah, they're a great company. This is not taking away from them. This is like kind of the direction, that the industry's going. And quite frankly, if you didn't do that for your company and they weren't willing to, also take a bet on you and so on and so forth, they would have not benefited from, all of the innovation and the growth as a result of you coming in and feeling a certain way. And in addition to that, I think that entrepreneurial spirit that you have, that, that purpose driven and passion that you have, that gets you on a plane with your mom to Florida, having a meeting with people before your company's even aware what you're doing. And I don't even know if they paid for your flight and whatever.
Yeah, no, they didn't at the time.
There you go. That's my point, right? Like, people don't invest in themselves enough to actually and bet on themselves enough. And that translates into every stage of any business. That franchisee that's like, what do you mean I have to personally guarantee this loan? What do you mean that I have to put up my house or whatever it is? Listen, if you're not going to bet on yourself and you don't think you're going to last in business for the 2 years that you basically have to guarantee on things, and that goes to leases, it goes to, limited personal guarantees and good guy clauses. If you're not convinced that you're going to be successful and you're not willing to do what it takes to be successful, you don't deserve to be. And I had to say all that shit because you could chop that up into 5 fucking clips, because I'm so sick and tired of people that think they're going to just start a business and go fucking mail it in and not be present and be uber successful and drive a fucking Bentley. I'm done. We could all leave.
Yeah, absolutely.
Pound
I mean,
it.
that's, we need
Let's
to
go.
like just make that into a whole thing for my, network to hear, because I do get those calls sometimes. What do you mean I have to personally guarantee? Oh, you want me to lend you a couple $100,000 for a new business that has no established cash flow, without signing on the dotted line? And I think what is so ironic about all of it is, we're a commercial lender. So the actual borrower is your LLC, your corporation. So they're the ones that are on the hook first. We call it the parade of miserables. When there's a default, we're going after first our borrower, the business. Then if there's any corporate guarantees, so if there's existing, locations, we would go after them. Those are secondary. The personal guarantee is a tertiary, part of the deal. And if your business files bankruptcy, and now I'm giving hints on how to get out, but I only do excellent credits and borrowers, and I structure, the loans. But my point is, by the time we would even try to collect on a personal guarantee, we're probably not going to. We're probably going to end up just taking the loss, because by the time you lawyer up and it ends up costing almost more money and more time than just taking the charge off. So I think that that's also really important. But from a morality standpoint, sign on the line. This is your business. This is, if you don't believe in your business and yourself, why should we? And
Totally.
that's,
Yeah, well, and look, the name of this podcast is "What's the Dealio," right? And it all comes back to the actual deal. I am going to tell anybody on the planet that if you can go get $1 million and not personally guarantee it, let me know where you're getting it from, because I want 1 million, I want 10 million, I want 5 million, right? And I'm never going to suggest to my clients to sign personal guarantees, especially on leases, right? Which is different than trying to get approved to borrow money to go
Sure.
start a business, right? But ultimately, there's everybody sitting here right now is willing to bet on themselves, right? We have to limit the risk, right? For the most part, and the more established you are and the more successful you are, you should be able to negotiate deals where you're not putting up much risk or collateral and things of that
Exactly.
nature. But when you're starting out,
Yeah.
like, who's going to give you any money without some sort of a guarantee?
Yeah.
Mike, talk about that. Dig into to that, because obviously you're always looking for good deals on the business sales side, and you're able to find things that I wouldn't even know about exist, which is really your specialty in that niche. You're helping folks leverage things in ways where you're able to buy businesses extremely creatively. Talk a little bit about that, because I think Ashley would learn a lot from that as well.
Yeah, a lot of our deals that we do are seller financing deals.
Oh, great.
So we have the owner put skin in the game, and I make sure that they bet on their business, because if they're telling me they're making $1 million a year and they're not, you know, that's an issue. Prove it to me. Finance 50% of the business. I only finance 20. All right, that's better than nothing. So we do a lot of seller financing. But
That's
if
great because from our standpoint, we like the seller financing because sometimes, especially if an M&A or an acquisition is taking place, and if it's like a struggling business that maybe doesn't show as much profitability and cash flow, but you've got now new management or new owners coming in that are going to take it over. Sometimes it's nice to have that seller financing in place because then we can provide maybe less of the funding aspect, and then the debt service we can make work. So I'm glad you
the
brought that
seller
up.
has to be in, how I train people that work with me, I train them to make sure the seller's in second position.
Right.
If it's real estate and property, they're in position on the business,
Right.
and then the bank is in position on the property. And if they agree to that, that's a great deal for a buyer. But going back to what you said, if you're starting a business and you don't personally guarantee it, why would someone or an institution give you money? They got to see that you believe in yourself. I'm all in about myself. Anything I do, I'll personally guarantee because I know at the end of the day, I know the result.
Yep. Yeah. And there's a connotation just to, I want to clear up for anyone that's listening. I think when people sometimes hear or, personal guarantee comes up, they think that it's going to show up on their personal credit reports. And I want to emphasize the fact that these are commercial business loans. So, if there's any apprehension or concern with that, I want to clear that myth because it won't show up on your personal credit report as an obligation, like a credit card or a mortgage will. The worst thing that would happen is maybe an inquiry would show up on, but those clear after a couple of months. And so,
So regardless of how many loans your businesses have, like, that won't show up on a credit report.
no, you'd
How
see
much
that.
debt essentially that you're in.
Yeah. Yeah, it's commercial lending.
interesting.
So like the only place that you'd really be able to see the business debt would be maybe like a Dun and Bradstreet
Sure.
report or a PayNet, like an actual business, a LexisNexis.
Yeah.
But if someone is, because I get this brought up a lot, hey Ashley, I want to open up XYZ franchise, but I'm also in the market. I'm buying real estate and I
Yeah.
don't want this to affect, and it won't. It really
Interesting.
won't.
Yeah.
And when we're going after these businesses, I always ask, do you have any debt? If they say, oh, I have debt with this company, I have debt with this seller, that's a perfect time to assume that debt and have less of an outlay down. And there's just so much to talk to you about, It's just
I know.
I have a question for both of you, and I'll start with Ashley. So, based on the current climate and just what you're seeing in the industry and the amount of deals that you guys are lending and things of that nature, give the audience kind of a, just general update on the climate, and where we are versus maybe where we were 2 years ago and where you see us going.
Yeah, I would say the climate right now is similar to, outside. It's rainy and it's torrential. Yeah, it's volatile. Unfortunately, rates are at an all-time high. And this is the first time in my career I'm seeing this too, because when I started in 2014, rates were historically low and they continue to be low. So we're in a high interest rate, high cost inflation. I mean, have you gone to the grocery store and seen how much eggs are?
Crazy.
So I do feel, like but it's cyclical. It's an
Yeah.
economy. And, I know that rates are eventually going to come down. I don't know exactly when. What I would say, given the fact that we are in this climate right now that is not ideal, this is the time to really like kind of slow down on growth a little bit, stabilize what you have. If you have very, very successful, profitable locations, then by all means continue expanding. But I think one of the things that people need to focus on and be mindful of is their projections and making sure. So, if you have projections that were, covering a 6% interest rate and you haven't updated those projections to what reality is now, which prime is at 8.5%, you're going to be surprised to see that, although I said before the monthly payment isn't that significant, costs have also gone up. So if your build out, expenses are, based on 2019, 2020, even 2021, you need to update those because costs have gone up as well. And so really just being careful of, making sure that you've got up to date figures on your costs. And I would say, conservation of capital is crucial right now. So really kind of hanging on to investments capital, and just keeping that on the side for a rainy day in the event that, you need to weather maybe a storm for a little bit, potential talk of a recession. I don't know. I mean, I think that it's always better to be, safe than sorry. And so, if we were having this conversation 5 years ago, it would be entirely different. It was grow, 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 grow. And I think a lot of the more sophisticated franchises and borrowers are right now focusing on like slowing down on expansion, focusing on what they have. And what's nice is that that's really allowing people to innovate and to really look at their brands and say, wow, maybe we could do this better. And instead of just focusing on growth, 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 like maybe we can actually, collaborate and come up with new ways to better our business as well.
I mean, that was
Yeah,
that was great. Just real quickly before you answer, would you say that you're getting less requests as well? Like when you say that it's like gloomy and people should be a little bit more cautious. Like, are you seeing the activity slow down as far as just underwriting deals and things of that nature?
A little bit. What I'm seeing are projects just slowing down a little bit.
Yeah.
So, some of the phone calls that I had last year with people saying, "Oh, we have plans to open up 10 locations
Yeah.
next year. Maybe now it's 5."
Sure.
But I don't feel, it's funny because like it might be rainy out, but it feels like the sun is still shining because I know that, there should still be that optimistic look on the future because rates will come down. So if anything, what I'm seeing is, and at the same time, certain banks are now pulling back.
Sure.
Where we're doubling down. Like
Right.
this is where we really show that we believe in this industry. Like
Yeah.
we survived a pandemic. 90% of our portfolio was on modification. I think we had one loss, and we lend predominantly to fitness centers who got pummeled during the pandemic. So, we are still lending. We're going to continue to lend. And so now, if anything, I think that we can cherry pick maybe the borrowers that we weren't able to maybe do business with in the more competitive climates with the lower rates. Now we're able to really double down on those opportunities. So
Awesome.
Great, great
Mike,
look on
what are
it.
you seeing in your space? And is there a decrease, an increase? Is it kind of steady? And where's the opportunity as far as you're concerned?
There's a ton of opportunity because our space really, I think I'm one of the first to innovate the business brokerage space. Um, there's 6 million businesses for sale. There's only 5,000 business brokers. So there's always business. It's just how do you professionally facilitate a deal where a lot of these deals are confidential and you can't just put it on the market. So how do you facilitate a buyer buying a business as a confidential matter and just putting everything together? Now having an arsenal of, like yourself on board, um, it's a win-win situation because I can basically build a list of businesses that I'm selling. I can see if they have any debt. I can throw them your way, and you can look at them and say, okay, this cash flow looks good. I can lend to this if the borrower has this experience, and it's just collabing right here. We could do business and on the business brokerage side, a lot of business right now.
yeah, for sure.
I feel, it's interesting because I think in the health and wellness space, and we were talking about this before we hit record, we're always, picking each other's brains. I think that, in my opinion, the pandemic accelerated the tired brands that were already kind of like at the tail end, like approaching their expiration dates. And I think the world changed so much, over this, the whatever it was, 3 years, that we were really in the heart of COVID, and I feel like there's so much opportunity specifically in health and wellness because there's just not that many exciting brands. And you and I are speaking on a panel next week at the same event, and that's what's interesting to me because it's just the same usual suspects, like, and I'm just being, you guys know me, I'm transparent, and I just see such a like. There's nobody close to Orange Theory, still,
Yeah.
this many years later, like they're
I'm waiting.
so far
I'm waiting.
ahead,
I'm like,
right?
come on.
Exactly.
It's like having a baby. Like, let's go. I'm ready again.
And you and I both literally travel the country looking for like the next Orange Theory
Yeah.
or like the next exciting, innovative thing.
Yeah.
And there have been concepts, and we were talking about this, there have been concepts that have gotten into the wellness space and have a whole bunch of different services under one roof. And I think that's great. And it's like almost like the gate. I always call everything the gateway, to something else. And I think, COVID also made us all realize that we're all, we all are going to die one day, right? And we're trying to like be as healthy as we could possibly be, and we're focusing on longevity and quality of life, and all of that stuff is so front and center. And with the amount of like, ideas and concepts, I think that like are launching, I'm still not so excited about many of them, and I think that's a little strange. Which to me, regardless of who's president, what the weather's like, what,
Right.
like all of those factors that, people who are not like waking up every morning, regardless of those things, and just looking to crush the fucking day, like none of that shit matters in my day. Right. And I feel like that there's just so much opportunity in every space, not just, and like we're all just positive, hardworking people that regardless of what the weather's like outside, we're just going to crush the day, and we're going to be first in line for all of the new exciting things. And, and I think there's more opportunity than ever.
Yeah, there's so much white space right now. And I agree. I think the pandemic kind of, it's funny because people will still look in this rear view mirror of like pre-COVID numbers. And I'm like, do you guys not realize that like everything is different now? Like we saw that with Peloton, we saw that with all of the home workouts, virtual workouts. Like this is a completely different space that we're in now. And how do we grow and innovate in this new environment that we're in. And so wellness and social media has blown up, like the cold plunges. Like I see you every day. Oh my God, I commend you for, you know, getting into those, like the ice baths and all of that. And so that's really what's I don't even want to say trending because that makes it sound temporary, but that's what is happening. And there's all these different services. And I agree with you. There are a couple of brands that I'm getting like that kind of tickle in my stomach, like I did with
me
Orange
too.
Theory.
Yeah,
And I'm
I don't
excited
want to say
for
there's
them.
none,
And
but it's just, I think there's
it's,
fewer.
yeah.
You know, fewer than there should be, because you would think that all of these smart people would have been like creating exciting shit during COVID, you know, and but I
yes.
think people were so focused on keeping the ship afloat, you know,
Yep.
that you weren't able to really, you know,
Yeah.
be that innovative. There are, you know, there were definitely some exciting brands for sure.
Yeah, for sure. And I mean they continue to pop up and like a big thing that I've been seeing is like hormone replacement
Sure.
therapy. And now, you know, with
Peptides.
yeah, with the suma peptides and so you've it's interesting. You've got these different categories. You've got fitness, you've got wellness, then you have the medical aesthetics, the
Yeah.
Botox, the fillers, then you have the recovery. Like
Yeah.
how does everybody play together and get along? Is it oversaturated? And I think only time will tell.
Yeah, I think the next frontier, it's already here, is more like the medical side of, you know, like wellness and beyond, right? Like getting your labs done and truly,
Yeah.
you know, bespoke, customized like solutions for you based on your body and, you know, all of the things. And that's already here too. So I think, you know, there's a lot of, we're just scratching the surface, you know, wearable technologies and, you know, all of that stuff, which has been around, but it's, you know, starting to um, go to a different level. But I do also think that, you know, people are starting to work out differently. And obviously, you know, you mentioned Peloton. I don't know how, by the way, like, how is it possible that somebody could miss so badly and think that, you know, COVID numbers are going to continue forever? Like
Yeah.
it's bizarre that
It's
people that
wild.
smart in that position
Yeah.
can actually think that their business is going to grow at the same rate when everybody's locked in their house, worried that they're going to die. Like, how could you miss that so badly?
It's scary.
Crazy.
It's the social aspect and being, you know, around people. We need that. Humanity
Course.
needs to be social. We need to, and so that's really where the industry has been going. I mean, it's I would be very surprised if somebody didn't have a gym membership to some degree in this day and age. And it's becoming more than just I'm going to go work out. It's I want to see, like last night I was at Adventureland with my kids for a fundraiser and I saw a girl there who I do Orange Theory with. I've never spoken to her, but we take the same classes and I was like, oh my God, and she knew me right away. And now we have this connection. Our kids go to school together. And so like, she's somebody that I might call up and say, hey, like, let's like hold me accountable. Let's hold each other. So it's the social aspect.
Yeah.
You're not getting that if you're on a Peloton in, you know, your living room. And that's great to have it, but it's going to be supplemented. It was never exclusively going to be that.
Yeah, I think it's the hybridization, like that makes sense. And I think people are going to like their weekly routine is going to change. And like I happen to jump on my Peloton bike because I'm injured and it was just an easy workout. I was pressed for time and it worked for me. But I haven't been on the Peloton bike since like the heart of COVID when I had it delivered to my house before I was worried that they were going to run out of them.
I just sold mine.
There you go. Mine's a coat rack.
Mine,
Right?
yeah, mine hangs my laundry, and it's like almost like a parallel universe. Not to jump around, but I think of it as almost like the hybrid workspace now. Like people
Totally.
going back into the office, people who are exclusively remote. Like I'm one of those people where I want to go into the office.
Me too.
I do like hybrid because I do like the ability to 1 or 2 days a week work from home, but
Me too.
I like getting up. I like getting dressed. I like having a purpose. I make Starbucks part of my routine. And that is how I show up. And it reminds me of, it's very similar to that, you know, mentality of the fitness space.
we're all, I mean, again, the three of us sitting here are wired the same way. It's not a surprise that the conversation's flowing and we can go on for hours and hours. And I think we need to, unfortunately, like wrap this up with a bow, but I think we need to have you back, Ashley. I think we're gonna have
Part
you
two.
right? I think we're gonna have you just like jump in on a monthly basis, maybe,
I
and
would
keep these
love
conversations going, because I feel like you're gonna make Mike and I more money, which is really the whole.
We're all gonna
goal
make
of this
money.
podcast.
Yeah.
Oh, all right. Well,
Yeah.
that's fine.
I mean, in turn, obviously, making you more money.
No,
right?
I'm teasing.
So, in closing thoughts, where can people find you, Ashley? Like, give us.
You can find me on Instagram. I have it's Bring Me the Bank
Love that.
is what it is, and really just Ashley Markowski. Google it, and I'll come up, and you'll be able to find me there as well.
Mike, any final thoughts?
Thank you. So nice meeting you. We're gonna do a lot of business. You're very intelligent. So
I'm smarter
And
smarter than I look.
and
That's
driven and resilient. And I hope you enjoyed this episode of What's the Dealio? Because we're about to go make some deals.
that's it, man.